As we speak, we're now seeing the 10-year yield on treasuries falling to the lowest since January 5th, below that 1.7% level. What are the implications of U.S. Treasury yields and the volatile moves that we're seeing in the yield curve for equities?
Well, unfortunately, you've got a pretty terrible policy mix now, and the bond markets are probably discounting that the Fed is going to make a policy mistake by tightening into a slowdown, and that the global economy will probably still see some latent inflation. So that stagflationary environment is pretty much being mapped out by the yield curve as we speak. But you should also note that credit spreads have also been widening over the last couple of weeks, and with a strong dollar, this is giving you a very bad backdrop for risk assets. So the reality is that you've got slowing growth, sticky inflation, and a policy tightening, which is pretty uncomfortable for equity markets and risk assets overall.
Especially given that, of course, broadly it could hurt consumer sentiment. And we know that consumption has been one of the pillars of the recovery. So where do you go in order to really hedge for all of this?
Well, unfortunately, the number of asset classes that tend to do well as you've got a flattening yield curve and potentially one that's signaling a recession is actually very limited. And in particular, this cycle has still got this inflation backdrop. So outside of the conventional assets like gold and to some extent commodities, unfortunately, you're being pushed into very boring parts of the equity market, which include utilities, consumer staples, and really some sort of big tech franchises which are semi-oligopolistic. So it's not a particularly nice equity backdrop. And unfortunately, I think we're going to see a pretty big slew of economic downgrades globally now. And that in itself is probably going to reinforce a big cut in earnings numbers as well.
Does that really pull forward not just fears of a earlier than expected next recession, but also really complicates the picture for what policymakers can do?
Well, that's really it. I mean, what the bond market is saying is almost that you shouldn't be, even thinking about raising rates at the moment. So this paradox is, I think, sort of highly unusual. And I think for equity investors and most people in markets, this scenario is not one that they've ever seen before. And indeed, you're coming off a period where you've had one of the strongest ever recoveries in global growth after a recession, only to find yourself looking back at the abyss of another recession sometime in 2023. So the reality is that, unfortunately, central banks have been caught in the headlights between a idiosyncratic risk in the Ukraine and one in which they've recognized that inflation pressures grew far more quicker than they had anticipated when they set out to tighten policy.
China, there's a cohort of investors that have been treating Chinese assets as being able to find value, but also almost as a hedge, or as, I guess, as a haven even against everything else that's going on outside of China. Is that a fair play?
I think parts of the China asset markets have actually performed pretty well given the backdrop that we've seen, and also in the sort of for the next 12 months. Chinese government bonds have held very well. The currency's been quite resilient, and in fact, it's probably now regarded as a safe haven currency. The difficulty for equity investors is the absence of growth, and certainly as you alluded to earlier in your program, the ambitious 5.5% doesn't sit very comfortably with a lot of the forward-looking indicators in China at the moment. And given the fact that the economy is unlikely to open up this year, given the surrounding concerns over COVID, and of course the sort of unchanged fiscal deficits, it's very hard to square where China's going to surprise on the upside in growth. So for equity investors, the good news is that the reach for yield theme will continue to run through most of 2022, and there's plenty of companies with very good dividend cover. But the absence of growth or potential growth surprises, I think, is going to mean that at best the equity market trades sideways and maybe relatively better than some of its peers, purely because it's already, as I say, got some degree of resilience.
Is that the broader picture for other Asian economies as well? Because, of course, it's a politically sensitive year for China, but also for South Korea this week. They have the presidential elections at a time when you continue to see rising prices and inflation much higher than what the BOK would want it. So more tightening perhaps on the way there too.
Well, that's true. I think one thing about the Bank of Korea is that it's actually at the front of the pack. So to some extent, the criticisms that were leveled at the central bank last year in tightening perhaps too early is actually played out now in one in which they've sort of at least got some distance towards the neutral rate. The difficulty for Korea is that it is very sensitive to energy prices, and particularly food prices as well, which is not necessarily discounted. The good news is that the balance of payments is strong, and also the economy has actually been relatively resilient given the very competitive level of the won exchange rate. So by and largely, because China's currency strengthened, countries like Korea and the economy in Taiwan have tended to do relatively better because of that competitive edge being restored. So there is some insurance policy for Korea if indeed they continue to tighten, as they will need to stem the asset bubble and tame some of the inflation pressures, but by no means as bad as some of the other EM countries that we saw last year and this year, which has been notable in places like Brazil.